Welcome back to the Sir Roger Gifford studio. I'm Rhian-Mari Thomas. I'm the Chief Executive of the Green Finance Institute, and for this penultimate panel, I'm looking forward to a really practical and pragmatic discussion about the role of public and private finance in financing the offshore wind industry. In Great Britain, we have a world-class example of setting up a successful renewable energy sector. 40% of global installed wind capacity sits around the British coastline. And it is a fantastic case study for how we can bring public and private capital together to create jobs and to create investment opportunities. And here to discuss that with me, I'm delighted to have a really expert panel. I'm joined here in the studio by Robert Begbie, the CEO of NatWest Markets, and Oliver Cass, the Finance Director at Dogger Bank Offshore Wind Farm. Welcome both. And here, joining us digitally, my good friend Sam Gyimah, who wears many hats, but today is representing Oxford University Innovation Board. So welcome, Sam. So on my first question, I think I'm going to direct to you in the hopes the technology holds up. And really maybe just stepping back in time and discussing how public and private finance did support the setup of offshore wind and what key lessons we think we can learn looking back at how that was done in the first instance.
Great, thank you. As you said in your introductory comments, Rhian, we have a live example here in the UK of how regulation and having the right environment can actually help drive down the cost of capital, but also attract private investment into the decarbonisation process to fund technologies. And what happened in the UK was firstly the contract for difference process, which meant that there was a transparent and long duration regulatory regime that meant that investors had a very predictable revenue stream. And then why is that important? It's important because often these technologies are expensive, there's been high cost, they're not mature. But investors are very cautious about the risk. So by having such a regime, it allowed investors to step into what was an otherwise risky and unpredictable situation. The auction system that was developed in the UK had worked very well, but also the administrative process. And I think these three things were at the core of the success of renewable energy in the UK. And so as we look at new technologies that are essential to the decarbonisation process, or we look at power generation in the global south, which we know has been a matter of discussion during COP, looking at these live examples and what made them successful is absolutely crucial to making a success of the transition to net zero.
Thanks so much, Sam. And maybe if I could pick up on some of his points there, Oliver, and just say, when we're thinking about investing in something like the offshore wind market, what are those key risks that we actually need to be thinking through in a bit more detail?
I mean, there are, to finance a project, there's a whole plethora of risks which investors need to get comfortable with. You know, the project financing can trip up on any one of them. What we've seen, I think, in the UK offshore wind market in particular is, as Sam said, the regulatory environment to facilitate it, but maturing across the entire industry, and that's maturing of the technology, an understanding of technology, maturing of the engineering know-how to deliver that technology. The contractors, the supply chain has become more mature. There are more contractors, creditworthy, experienced contractors able to deliver these projects in the market. And then the management teams that are delivering the projects and ultimately making sure that what we say is going to be delivered does get delivered, also have more experience. And there are more experienced teams around the UK working for various developer organisations. And you bring that all together along with the advisors advising who are also getting more experience. And actually the whole industry has rapidly matured over the last 5 to 10 years from one point where it was seen as highly risky, difficult, not sure whether it's ever going to take off. And now it's seen as very deliverable at real commercial scale across multiple different projects.
So a classic example of needing somebody to step in to help de-risk an unfamiliar technology, an entirely new way of project management, a whole new set of risks that people aren't familiar with.
Yeah, I mean, so your first question, the public-private kind of interface partnership, the CFD has certainly helped to facilitate this rapid maturing of the industry. And the industry was given a huge cost reduction target, and financing is part of that. But that goes across everything, developing technology, contractors being able to deliver. Also, the cost of finance needed to come down, but you can't deliver at scale without a lot of finance as well, and that is one area which has particularly evolved or expanded over the last sort of 5 to 10 years. For example, Dogger Bank, we closed the first 2 phases of that project last year, and that was at £5.5 billion worth of debt finance committed in one go to these 2 projects. 30 banks were involved. We had 3 export credit agencies. We're bringing in the export credit agencies who those particular ones didn't have much experience of offshore wind. By developing the projects and delivering the projects, it's also developing the market, and that includes the financing market as well as the sort of technological and contracting market.
So let's talk about Dogger Bank in a little bit more detail then, shall we? Bring in Robert from NatWest. Your observations, comments on that particular transaction?
Yeah, I mean, that transaction, I think, probably culminated that 10-year journey, because we as a bank have been in that journey right the way through. I mean, we've been the #1 lender to renewable projects over the last 10 years in the UK. So as the public and private partnership and the risk reduction and the understanding of how public and private have played a part in that, these are now, they're large, but they're familiar processes we go through now. So the teams we have are now pretty expert at working on these transactions and working with, and we've talked about collaboration a lot this week, but you've got 30 banks in a deal. That takes some doing in terms of pulling all that together. But what we know is that this is not a new technology anymore. This is an established technology, and it's established technology in an area that we know there's a lot of money trying to find a home. So this was a great example, and quite a groundbreaking example, I think, of where the industry is going, not only in the wind space, but as we get new technologies coming through, the type of model that we can replicate to really build out those alternative energy sources.
I really want to get back. I want to get onto that point in a sec, but if I could just ask, as a banker, what were the specific characteristics of this particular transaction, or offshore wind financing in particular, that makes it something that appeals to global markets, private finance?
I mean, you've seen, it comes back to, and this was pre our purpose, but we've been in this market some time. We've come out with commitments over the last couple of years in terms of the amount of financing we want to provide into that market. We initially set a 20 billion target for over 3 years. We got there in 18 months. We've now come out with a 100 billion target, by 2025. So that in itself sets a challenge within the organisation that this is where we want to go, and these are the types of things we want to support. And once you get the bank behind it, the benefits, both the financial benefits for the bank, but also in terms of pursuing those purpose-driven initiatives and supporting these projects, is pretty straightforward.
We need to repeat that stat. 20 billion, and it was your target, and you met it in half the time you'd set yourself. Yeah. And that is fantastic, and just shows the appetite and the momentum behind green finance. But anyway, we could digress about that further. But wanted to pick up the point that you made about, we could try and apply this model, the financing, to other sectors. And I wanted to bring Sam in particular, thinking about some of the new disruptive technologies. Hydrogen in particular comes to mind. Other innovative technologies too. Applying these lessons and just getting some of your insights and thoughts on that.
Well, I think what characterizes, whether it's hydrogen or carbon capture and storage or bioenergy, all of these are essential if we're going to decarbonize some of the hard-to-abate sectors, is their relative immaturity, the high cost of developing them. And so we need a regime that attracts private capital in order to do so. My view has always been that government balance sheets are so stretched post the pandemic. I mean, they were before the pandemic, certainly so after the pandemic. So private capital is going to be absolutely critical in order to finance these technologies. And if you think about it in that context, then drawing the parallel from what's happened with renewable energy, you could see how you create a similar regime to fund some of these new technologies at scale, particularly attracting private capital in at a relatively low cost of capital in order to make it a reality for, say, hydrogen or carbon capture and storage in the case of the UK to be more of a reality.
And something that we haven't touched on in our comments so far is the role the Green Investment Bank had right at the beginning of the offshore wind story, obviously providing some of that capital to meet the project and construction costs. And we find ourselves now with the UK Infrastructure Bank, already done one transaction, but it's only been up and running a few months, but high hopes maybe that the UKIB can step in and maybe take that role. Your views on that, Sam?
I think it's absolutely critical having that kind of institution that is adjacent to government, supported by government, and able to play a significant role across the piece, which is what the Green Investment Bank did, and really think long and hard. I think, Rhian, you and I have discussed this in the past around the kind of structures that are necessary and how to see them and work with our private capital in order to do so. And I think it's very good that it's slightly sort of removed from government rather than sort of part of the normal government process. I think that is also crucial to be able to get the kind of long-term thinking that is needed to put these mechanisms in place.
And Sam, obviously speaking there as a former government minister, as well as somebody that spends their time now looking at innovative technologies and working to look how we can finance them. So thank you for that. I think I'd like to chat maybe again about going back to Dogger Bank and some of the comments that you made earlier, Oliver, about the driving forces behind the declining costs of renewables financing. And just digging to that a little bit deeper, how you mentioned it, how we've seen that cost curve come down over the last few years. Is that just an economies of scale argument, or what exactly did happen there?
I mean, so there's two elements to this. There's the cost of financing, and then there's the overall cost reduction of the projects. And the cost of financing is one element of that overall cost reduction story. In terms of the financing cost, I mean, it goes without saying that the cost will come down if people understand, if there's more competition, and the financiers understand the projects better, have more confidence in them, and therefore the risk pricing goes down. Fundamentally, that's kind of those are the driving factors, and that's absolutely what's happened in offshore wind. There's a huge amount of competition. We had 30 banks on Dogger Bank, and there's other banks who would have been interested. And that's just banks. There's the kind of other investors also who would like to be getting in on this. From the kind of the equity sponsor side, there's a multitude of kind of organisations that want to buy in to these projects. So the competition drives that reduction, and then the reducing risk profile. And the reducing risk profile is from the track record that's sort of been built up. I guess the overall regulatory environment facilitated a huge amount of investment of time, people and resources into the sector. People could see that it could be delivered at scale, and therefore was actually going to be worth investing a lot of time, effort and resources into the sector. It was clearly given a big challenge. 5 years ago, to get slightly technical, the strike price for the CFD was maybe 3 times the wholesale market price for offshore wind, and for onshore wind and solar it was much lower, much closer to the wholesale market price. Now offshore wind is the cheapest. And the strike price, which developers are bidding into these auctions that are run, is akin to the wholesale market price, and it came from a starting point of being a long way behind the other technologies, but I think because people could see the scale of what could be delivered, it attracted that investment to have a very rapid path of cost reduction. I mean, it'd be interesting to see how that goes, because that cost reduction clearly also gives challenges to developers in terms of continuing to pushing the boundaries of technology and the boundaries of other elements, aspects of the projects. And pushing the boundaries increases risk, but we're trying to reduce risk, and we're continually trying to make sure we've got the right balance of managing those risks, keeping the risk low while delivering sort of cutting edge projects, which are then going to deliver the value ultimately for the consumer.
And that pricing curve also creates some problems for investors too, right? Because this has now become quite a commoditized area for investment, harder to get higher returns. I guess that's true. But the point I wanted to really pick up on was your point about the strike price. So what is important about that, I guess, is government funding over time. It really acts as a pump prime for this. Like, you no longer need it when the strike price is the equivalent of the whole-sale price.
Yeah, I mean, it's also worth reminding ourselves that the strike price, that strike price, to the extent it needs to be funded, is funded back to the suppliers, back to consumers. And so, it's ultimately the consumers, and that is that also has been paramount in the regulatory environment, which is cost to consumers, which has then driven which has driven the need to have this competitive auction environment to minimise the cost to consumers, which of course creates stresses and strains from the developer side because we don't know whether we're going to win, and everybody pushed themselves to be as competitive as possible while still being able to deliver the projects.
And to date, that's been a successful model, and the developers have all succeeded.
I think absolutely, yeah. And it's certainly been a successful model from an independent, external viewpoint. And yeah, absolutely, we're still delivering the projects, and they get bigger and better every time.
So I guess we talked about some of the key elements: the contract for difference, the strike price, the auctions, the need for the Green Investment Bank to step in, all those jigsaw pieces. And now, obviously, we have even more appetite and demand from the private sector to find these kinds of transactions. So should we expect what we've seen in offshore wind to be replicated even more quickly in some of the other promising renewable energy technology sectors?
I think you should entirely expect that to happen. I mean, I think you've currently got an imbalance between demand and supply. There is this enormous, the money. We've seen a lot of stats this week. We've got the Mark Carney 120 trillion. But even if you look at the wholesale markets, for bonds, we've had $625 billion of green and social issuance this year. It's up 130% on last year. So the demand is out there to find a home to fund green and sustainable projects, whether that be in the wholesale market. And you mentioned there about financial sponsors, and increasingly we are seeing private equity, private sponsors coming in and really starting to play a part in this market as well. So you've got this virtuous cycle of investors chasing sustainable assets. They obviously want to make a good return on those sustainable assets, but they can see the future potential of getting in early, at the same time as we have seen we call the greenium, right, start to emerge, right? It's starting to emerge because people see issuers with sustainable projects, with sustainable issuance, as being more likely to perform better over the medium term than non-green.
It's always been a bit difficult with that greenium, isn't it? Because there's something a bit perverse about making it, getting the balance right between the cost to the actual issuer and the cost to those investing. So as somebody as an issuer, you obviously want your green bonds to be cheaper because they're green, but then we're penalising investors by saying, you're investing in the right thing and you get a lower yield.
Yeah, but remember, again, when you do something like that, it's all based on supply and demand. The price gets set, and you give an example, not in the energy market, but in the government space. I mean, we were involved in the latest UK Green Gilt, long-dated gilt, 6 billion of issuance, 74 billion of demand for that 6 billion, right? Incredible, the most demand of any green bond ever. So that's supply and demand, and those dynamics will always play out, that you've got more demand than supply, you're going to get a better price, and investors accept that.
And that's a conversation I've had with a few people offline here at the COP. very interested in issuing green bonds, a little bit concerned about the cost of doing them, because obviously you have to pay for the second party opinion, you have to pay for auditing the use of funds, etc. But when there's that sort of supply-demand imbalance, you're going to get tighter pricing, and it should be able to cover your administrative costs. I guess that's a good news message we'd want to get out from our platform today. Okay, great. Just a quick question, sorry, while I'm still speaking to you, Robert, about we hear a lot of people saying that it's mostly foreign investors that have invested now in the offshore wind market. But that's, that's a positive, or is there something that we should be doing to try and make sure that UK investors are more familiar with these types of technologies?
I think UK investors are probably becoming more aware of it. And if you think about London, right? We have investors all over London. Some of them are UK based but global players, and some of them are foreign based with operations in London. The thing is that finance doesn't respect boundaries, right? And that's the beauty of what we're doing here, which is we're taking finance and capital from around the world that's trying to find a home in sustainable projects and getting it to where it's required. And we're just going to see more of that.
And that goes to the points that both Sam and Oliver have made about the importance of having the right regulatory and policy backdrop, providing that sort of policy signal and that long-term confidence so that investors, as you say, from all over have that confidence. I'm conscious we've only got a few minutes left, and so I'd like to ask the question I ask everybody that appear on our platform, which is really sort of, I guess we're day 4 of COP now, highlights of COP, what you're hoping to get out of COP, maybe some responses to yesterday's announcements at Finance Day. I take it, Sam, you've been glued to our channel watching what's been going on at COP for the last few days. So maybe start with you and, some of the government announcement yesterday. It was quite a big day for the Chancellor.
It was, and also I think you've had a terrific lineup, obviously not commenting on the current one, so well done. Some great announcements. I think for me the biggest thing here is private capital and the role that private capital can play in the transition to net zero. There's been a lot of nervousness around whether or not we can afford the transition, and whether going down that path means that individuals have to change their behavior in ways in which will be quite challenging for them. But I think what this particular panel shows is that actually innovation, financial innovation that brings in private capital can make things cheaper and better for people. And I think what the Chancellor did yesterday, nudging business further down that track, sort of underscores it. I think so for me, it's very successful in highlighting the role of private finance. I think that is going to be critical for the transition.
Thank you, Sam. And Robert, your views?
Yeah, I mean, this was my first COP, and everybody says they've never seen it this way, with private financing playing such a big role. For me, it's just reinforced what I've seen over the past 18 months, is that private finance is going to be a force for good in this whole transition. And it's our job really to make the connection between what we know is this capital that's trying to find a home right the way through the big projects like Dogger Bank, but then taking that down into the real economy and really finding a way to finance that whole transition.
We just heard Lord Billen-Moria saying, business can be the force for good here, and obviously, finance included in that statement. That's great to hear. And final word to you, Oliver. I
mean, 2 things really. Probably in terms of for COP, I've been really struck by the kind of the breadth and depth of kind of the initiatives and ventures and things that people are getting excited and enthusiastic about, and all of this needs to happen for us to be successful on this overall global transition. And then from the financing perspective, there is a huge amount of appetite and interest, and people do genuinely, I think, that work in this sector, they genuinely think they're working in the right sector, doing the right thing, and we need to make sure that the regulatory or other circumstances facilitate that finance staying in the sector and helping deliver. We've got huge ambitious targets. We need the finance to enable us to deliver those.
Hear, hear. Fantastic. Thank you very much to all the panellists, and that brings to an end of this conversation, and we'll be handing over to Axel and the team for our final wrap-up of the day. Thank you.